This is our video for the ETF investment model. The ETF investment model is based upon a signal composite of 240 daily indicators for each of 317 ETFs. In other words, we have 240 times 317 indicators within this model. The model is a composite of indicators that uses variations of breadth indicators, overbought, oversold indicators, money flow, sentiment, volatility adjusted indicators, trend exhaustion indicators, trend following indicators, as well as consensus earnings and sales trend indicators. The ETF investment model has been developed to provide a couple of different perspectives. First perspective is for the broad U.S. equity market as represented by the S&P 500. When the model is bullish or greater than 20%, you can see that the S&P 500 has actually gained at a 16.4% annualized rate of return. When the model's been bearish or below minus 20%, you can see that the S&P 500 has actually declined at a 25.7% annualized rate of return. And then there are times when the model's just saying be neutral. And when the model's neutral, the S&P 500 has gained at a 3.5% annualized rate of return. The second perspective is based on developing trading signals. In other words, we have buy and sell signals denoted by green arrows and red arrows. The green arrows are defined when the model goes above 0%, and the red arrows are defined when the model goes below 0%. And you can see here that the signals have done a pretty good job of identifying areas of high risk versus areas of opportunity. We view these signals as get ready to buy and get ready to sell signals. When you see green, it's time to look for those areas of the markets that are oversold and showing compelling valuation opportunities. Conversely, when we see these red arrows or sell signals come into play, it's time to reduce your exposure to risk assets. So now we know that the ETF investment model tells us exactly how bullish or how bearish our indicators are overall. We also have our get ready to buy and get ready to sell indications. Let's take a look at how the model has performed historically. Here we've taken the buy and sell signals, and on buy signals we buy the S&P 500 index, on sell signals we go into cash. The green line represents the returns of that particular strategy. You can see that it's done a little bit better than the S&P 500 since 2002. The S&P 500 is represented by the black dark line here. Specifically, you can see that during times of duress, this ETF investment model did a good job of moving into cash and avoiding risk. Let's take a look at 2008. You can see that this particular strategy was down 2.2% versus almost 37% for the S&P 500. But that's only one part of the equation. The second part of the equation is getting back into the markets. A lot of people have a good sell discipline, but they don't have a good buy discipline. This particular model provides a bit of both. And you can see that during the second worst financial crisis in U.S. history, this model prevailed. That's a quick look at the Griffin Hagan ETF investment model. We recommend using this model to help you identify periods of potential opportunity versus periods of high risk. As a client, changes to this model will be emailed to you daily.